Welcome back to Blockchain Basics. In today's video, we're going to take a look around the market to see what's been going on recently. And I'm going to make the case to you that we are heading closer and closer to another major recession. We will look at a number of charts, including the S&P 500, gold, the US dollar index, oil, and of course, I'll put all of it in the context of what it means for Bitcoin and the rest of the crypto market. So, let's jump in. Like usual, we're going to start with the Bitcoin price chart, but this is actually a screenshot from my last video, which came out on February 5th, almost 2 months ago. In that video, I talked about how I would invest my first $2,000 into the crypto market if I was a beginner. Of course, it was not financial advice, and neither is this. But in the first couple minutes of that video, I described the pattern that I thought we might be making. Specifically, I warned you that Bitcoin was likely to retest these lows again, and likely even make a new low. And I described this orange box here as, quote, possibly the best buying opportunity of 2022. Admittedly, that is a bold prediction to make. After all, what kind of events would have to happen to instill that much fear into the markets? It turns out the threat of global nuclear war, along with massive consumer price inflation, will do that. Now, Bitcoin never actually did make a new low. It would have needed to drop another almost 4% to complete the structure that I was looking for. But much of the market did make new lows. As I'll show you, February 24th and the few days just before and after brought the most fear we have seen in the markets since March of 2020. And while the general sentiment at the time was that the markets would continue to crash much lower, the truth is that this sort of fearful negative news often marks the end of a correction rather than the beginning. So yes, Bitcoin may have held up pretty well without setting a new low, but looking around at the rest of the crypto market, Cardano did set a new low, so did Dash, and EOS, and XLM, and even Dogecoin. And even looking at the total cryptocurrency market cap, excluding Bitcoin and Ethereum, put in a new low on February 24th. But it wasn't just crypto. This was a global macro event. February 24th marked the bottom for the S&P 500 and for the Dow Jones Industrial Average. And it also sparked a massive rally in the US dollar index, as well as the commodities market, where we saw a huge reaction in gold, which continued over the next 2 weeks. And of course, if any of you have been driving a car in the last month, you'll be aware that it did the same thing to oil. So I try to admit when I've been wrong, and in fact, I was wrong about Bitcoin coming down and setting a new low. However, the broader point that I was trying to make was that this is not the buying opportunity, that it seemed like we still had one more capitulation to see in the markets, and that this would be the region where you would want to be buying whatever you were interested in buying. Now, if you remember the sentiment that was going on February 24th and that whole week, it was not a sentiment of, oh, this is a great buying opportunity, everybody should be going out and buying stocks or cryptocurrency. After all, why would you want to buy stocks or crypto when it seems like the whole world is about to go to war against a nuclear power? That would be almost as stupid as, I don't know, buying during the beginning of a global pandemic. Of course, we don't know that we're about to break out into new all-time highs like we did in 2020. But we can confidently say that this was a better time to be buying than back in November when it seemed like the market was unstoppable. And this comes back to the principle best stated by Warren Buffett, that you should buy when others are fearful and sell when others are greedy. The market was greedy up here. Market was fearful down here. Market was greedy back here. Market was fearful down here. But wait a second, Blockchain Basics. You might be thinking to yourself, you warned us in November that Bitcoin wasn't going to keep going higher. And then everything has just been crashing since then. Isn't that just confirmation that you were right and the bull market's over? And of course, the answer is really that we don't know for sure what's going to happen next. But if you can ignore the narrative of the present moment and the emotions that come along with all of the fear and uncertainty, it is possible to remove yourself from the herd mentality. Most investors lose money almost every time they make a trade. One study found that accounts that do the best are the ones where the owner lost their password. Because built into our psychology is the idea that good things stay good and bad things stay bad. We're constantly tricked into believing that when a stock has gone way up, it must continue going way up forever. And likewise, if we own a stock that has been going down and down and down, we're likely to sell it at a huge loss, often at the very bottom. Instead, it's important to remember this concept of regression to the mean. Bitcoin is the perfect asset to see regression to the mean at work. It oscillates around a fair value. Whenever it gets too overvalued, it comes back down to the fair value, and then usually overcorrects. So when it's up here above the mean, it's a good time to be taking profits. And when it's down here below the mean, that's a good time to be buying. Unfortunately, very few people have this insight and the emotional control to be able to do this. But that is exactly what this channel is about. The goal is not to predict the exact top or the exact bottom or pretend like we know exactly what's going on in the market. The goal is to identify how much risk we're taking on by buying. And if you're buying below the mean, you can have a fair amount of confidence that, well, yeah, it may stay down here for a while, but eventually it is going to regress to the mean. And likewise, if it is above the mean, sure, it could keep going for quite a while, but eventually it is likely to come back down to the mean price again. And now we've really gotten to the major point of this video. The US stock market is long overdue for a correction back down to the fair value. Major signs of weakness in the market actually started to show up back here in 2018. At that time, the Federal Reserve had been attempting to raise interest rates, which had been historically low, basically kept at zero since the Great Financial Crisis in 2008. And the markets reacted poorly, and so the Federal Reserve had to stop raising interest rates and eventually even lower them again, because the markets had become reliant on these easy money policies of ultra low interest rates and quantitative easing. And around the same time, there were also massive corporate tax cuts, which contributed to further growth. For investors, this was a good thing in the short term, but essentially what was happening was the Fed and the government were propping up the market, allowing it to get further and further away from the mean. Then in 2020, as you all know, the bubble finally started to pop. But what happened? Again, the Federal Reserve lowered interest rates back down to zero, and the US government injected trillions of dollars into the economy. As a result, even though economic output slowed and people were out of work, stocks continued to climb. The point of this is just to say that we're on borrowed time, that we're due to revisit the fair values, and that would result in a very significant loss, similar to what we've seen in past recessions. And more importantly, the next time the market crashes, if the federal fund rates are already at zero, if US government debt is already at record high rates, there's going to be very few tools left in the toolbox to deal with these consequences. So what happened in November and December to start this 4-month downtrend? Well, the Federal Reserve announced that they were going to start raising interest rates aggressively in order to combat inflation. The markets are now expecting as many as 9 interest rate hikes this year, with more coming next year. Meanwhile, the yield curves are beginning to invert. March 28th, the 5-year and the 30-year Treasury yields invert for the first time since 2006, fueling recession fears. And the 2-year, 10-year Treasury curve is about to do the same thing. Generally, this is indicative of a recession coming within the next 18 months. So now we have to start to speculate a little bit about what could be coming. Now imagine that the Fed announces that in order to keep the economy stable, they're going to take a less aggressive approach so as to not crash the entire economy. After all, inflation is important, but they have dual mandates to combat inflation and keep full employment in the economy. And we've seen throughout the last decade that the Federal Reserve has done whatever they can to keep the uptrend. Nobody wants to be responsible for crashing the world economy. So maybe at the same time that the Fed says, well, we're going to go a little bit easier on this quantitative tightening than we originally expected, than the markets have already priced in. And at the same time, maybe we get some news suggesting that, well, perhaps we're not actually headed towards World War III. This might do two things. First, it will provide the conditions for further economic growth. It will remove the uncertainty from the market. Second, it will probably induce fears about further price inflation. So what would happen next? Well, seeing the value of their savings collapsing due to inflation, plus the temporary return of stability to the world economy, people are going to rush into the market in an attempt to prevent their dollars from losing value. This will push markets back into new all-time highs. And as markets move into new all-time highs, it will draw even more people in for fear of missing out. This could be an extremely lucrative time period. We often see big surges before big crashes. We saw it back in 1999, for example. Huge surge right up to the point where it all collapses. Same thing in 2006 and 2007. We have a moderate rate of increase, and then a big push up towards the end. This is the Dow Jones over the last 30 years, going back to the early 90s. This is on a logarithmic scale. If I take it off a log scale, this shows exactly how much of an uptrend we've been in compared to any other time in history. This is the Dow Jones in the 20 or 30 years before the Great Recession. And again, when we take it off of the log scale, we can see how massive of a bubble that really was. When we put these two side by side, it's hard not to see the similarities. Again, remember, back in 2000 and 2007, these were the all-time highs. They might look like just little bumps in the road right now, but these were in themselves massive bubbles, as they were in the 1910s and early 20s. You have two major bubbles that precede a huge run-up, which in fact pauses out for several months before going on to see one more push-up. If we're going to continue to follow this pattern, then that would suggest that these last few months have just been this area in here. And in fact, they have been about equal in size, about 12 or 13% on each of them. So that would suggest we still have one more move up to go. And that also lines up with the idea that we've not yet completed the Fibonacci extension from this 2008 crash. And looking at this, we would still need to set a new high by about 7%. Or from where we are right now, that would mean the markets would go up another 13%. So to wrap everything up here, it seems to me like the last few months have really just been a big ABC correction in the stock market, where we have waves of equal length and that we're getting ready for probably another 5 waves to the upside. But in the back of my mind for the last several years, and especially now, is the acknowledgement that we are well overextended, and sometime a correction will come in where we don't keep going higher. Bitcoin, on the other hand, continues to oscillate in this parallel channel that we've been in basically for the last 14 months now. Like I explained in one of my recent videos, it's pretty hard to tell at the moment whether Bitcoin is just doing a retracement and then heading lower, where it comes up to one of these 702 or 786 levels, or perhaps we're getting ready to break through to a new all-time high, in which case $85, $90, $100, even $120,000 does not seem unrealistic. In the event that we are just in a retrace before we head lower, this range could still be a very good opportunity for other cryptocurrencies. Just because Bitcoin is done doesn't mean that with a little bit of optimism, when Bitcoin gets up into the 50s, even approaches $60,000, that couldn't send some of the altcoins flying by hundreds or thousands of percent. So in the back of my mind, I'm waiting to see what's going to be happening as Bitcoin does work its way through its retracement levels. And of course, I'll be updating you guys, and hopefully we'll start to see some signs of life in this market. That said, I think it's safe to say that for at least a few months, the bottom is in, both in Bitcoin and the stock market. And with that, I want to thank you for watching. I want to thank the 4 people who consistently like these videos. You guys are the real MVPs here. The rest of you, thanks for watching. Remember, I do not have a crystal ball, and I do not have any sort of financial degree. So do your own research, talk to a financial advisor before investing, and I'll see you in the next video. Have a good one.